This is Morning Stock Watch with the weekly report for the week ending March 13th, 2020. This report includes the broad market along with Netflix, Tesla, as well as Walmart. Starting with the S&P 500, SPY, weekly closing price 269.32, down 9.4% this week. Another volatile week in the markets. News behind this week's market action largely includes the coronavirus ramping up, with it now being declared a national emergency. The weekly chart for the SPY closed as a very indecisive spinning top, if we can even call it that, ranging from the highs of 288.52 and lows of 247.68. Lows are now minus 27% from the 52-week highs, with price closing the week at 269.32. The weekly RSI is now oversold, which is the first time since August 15, 2011. This also sets a new low on price and on the RSI, which also means that there are some emerging divergences between the current low and the one set December 24th, 2018, easily seen on the weekly chart. This has the potential to set up as a bullish continuation move, but the threat of those divergences being swallowed up with possible lower prices persists throughout the fear of the coronavirus and the effects of it on the economies. To get a better sense of what happened with price this week, we look closer at the daily chart. On Monday, we had a brutal gap down, and then a bounce back up to the support at the Fibonacci resistance, and then an even harder gap down, eventually to the lows of $247 or so. The hourly chart, we can see the structure after the first 15% drop, starting at the first double top at the center Fibonacci resistance, and then a 13% drop, followed by a slimmer double top with some divergence, and then another 16% drop. This time around, the bounce managed to close just above the 100-period moving average, which ended the week on a bouncy note, but still has a lot of overhead resistance to get through. On the weekly chart, we already know about the strong negative divergence that's playing itself out right now with all of this new volatility in the market, so we could easily have lower prices ahead of us. The SPY is just barely RSI oversold, which tells us some information, but at the same time not very much, because price could easily become much more oversold. Right now as it stands, if price were to bounce super hard, that would signal bullish continuation. It doesn't look like it right now, but it could happen. Shifting focus to other areas of the broad market, simply looking at the weekly candles in comparison with the S&P, all of the charts are pretty much saying the same thing. Lots of indecision. QQQ, SMH, and SPY, with the indecisive spinning tops, and the financials with the bottoming doji candle. The rest of the charts have long lower wicks bought up from the lows on Friday. Again, this suggests that there could be some upside for sure, but how much and when is another story. Last week, looking at the VIX, we were starting to see a lot of upper wicks along with bearish divergence. This is bullish to the overall market. However, you can see that we had continued selling, but still diverging lower, signaling to a substantial upside in the market. Generally, as the VIX grows higher, so does volatility in the market. Since the market can and usually falls way harder than it can climb, it is safe to believe that these peaks are crashes in the market. This current crash we're in now has two dominant peaks that are both overbought. While the candle bodies are diverging from the oscillator's peaks, this is a bullish development. So let's go back to the S&P. As always, there are two sides to every trade. The idea is to be on the good side of the trade more times than not, with each trade having limited risk. With that said, looking at this 20-year chart, a couple weeks ago we showed how divergences played a role in the 2008 crash. RSI was much more oversold in 2008. Market crashed by 56% from the highs. So far, we're only 27% from the highs. The market could actually have a reversal at any time, but clear areas of support on this 20-year chart appears to be around 240 and the range between 203 and 213. It may not make it down there, but if it does, those will be heavy supply zones, having many buyers. So let's move to my other favorites. Next is Netflix. Weekly close, $336.29. For a good while, Netflix held a good fight to the market crash, but finally succumbed. We saw tons of volatility right at the super strong resistance of 385. Last week we said if it could not hold above the moving averages, it could break back below the wedge in the direction of $300 or lower. This past week we made lows of 304. I wanted higher for Netflix, but the market is not quite ready for a reversal just yet. On the weekly chart, we can see that Netflix is an obvious textbook ascending triangle. When bullish patterns are this clear, they never make it easy when it comes time to trade. They're gonna play a game. I'm looking for this to either overshoot below or shy it by 5% or so. This is still bullish for prices over 385 if it can hold, which it looks like it will despite the noise that will come with it. Very bearish if this bullish pattern fails. For example, if it breaks below and fails, making it back into the wedge means likely lower prices if that were to happen. Next we have is Tesla, weekly close price 546.62. Lots of downside price movement with Tesla. On this chart, there are three sets of patterns shown, with the largest being a bearish ascending wedge with bearish divergence, which played out perfectly to the downside, finding support at 630. Had it bounce up and created a bearish descending flat bottom triangle, played out perfectly with more downside, leading to the third pattern, a descending wedge along with oversold bearish divergence, which is bullish for some kind of upside as it has hit $500 support. Lower areas of support are 480 and then 430. For upside, we need to consider the resistance areas of trouble at 600, 630, 685, and 720. We did close the week a lot lower than the wedge, but I'm interested to see if this is just part of the game and we have a large gap up on Monday. And last we have Walmart, weekly close 114.10. On this chart we have a lot happening. We can see a weekly chart here with divergent lines on price and RSI peaks. Above 120 is the goal for Walmart. Things technically look bearish in the short term, but Walmart is only down 5% from the highs, with the lows of up to 14% from the highs. That's half the downside the market has taken, which is 27% below its highs. Also, there are some bullish continuation divergence. That in itself shows that Walmart is doing something right. I have a Fibonacci retracement running from the lows on May 28, 2018 to the highs on December 16, 2019. We can see lots of price action at 96.66 as well as 101.26 retracements. The weekly candle is extremely indecisive, but along with these bearish signals, it's possible Walmart could see as low as $95, which appears to be where it would maybe begin its journey to above $120.